All right, welcome back to the channel. So today is going to be a little bit different. I'm going to go over maybe just a couple stocks, some updates here and there, and kind of get my thoughts out on a couple different things. So first, let's dive into REITs because everybody hates REITs, right? So they're trash. REITs have been having a really rough time, especially we've kind of seen a bounce back in the office space and office REITs when looking at like something like KRC. But a lot of the REITs that are more triple net leases and have a higher valuation have continued to see a pretty nice downfall or downtrend. Like CCI, AMT, ARE is kind of like a mix. Like it's a life science / office REIT that kind of trades like a triple net. Like I don't know. But ARE had a short report released on it and went over that report. Personally, I think the report stretches in some areas for the bearish cases, and I'm not really too worried about it. So, but it has remained pretty dang weak. I've been in and out of ARE a little bit here and there. I was in it initially around like 119, I think, and then sold off in the round break even, I think, to get a little bit more capital to go into some of the office space REITs that were really beaten down at the time. Now ARE is back to about $100 and decided to initiate a position about 110, and then I took a very small position, pretty much a watcher, and then I built that into a starter as it dipped below 100 in the 90s. And if I go back to the valuation, I was kind of looking at like 120 as the base case for the entry point and about 86 for the bearish point. So if it can get down into the 80s, that'd be crazy. Right now it's trading at around a operating cash flow multiple of, dang, what is it? I think it's like 16. No, that's KRC, about 9%. So just from a 5-year average, looking at operating cash flow, it's trading pretty cheap compared to its historical multiples. We've got 4.22% on the 5-year average for operating cash flow yield. And right now it's struggling along about 9.05%. Something that I did like about ARE, what they did over the last couple of years is they really kind of took some decent low debt. I believe they restructured their debt. They got their leverage ratios pretty dang good. So going into this higher debt environment or higher interest rate environments, they positioned themselves pretty well. So with that being said, like the Fed raising rates, well, they didn't raise rates, right? They kept rates flat. But they kind of changed their demeanor on the long-term outlook of rates, and they basically have been saying or posturing that rates could be higher for longer. And what does that do on long duration assets, especially assets that have additional risk because of interest rates? Well, it's going to re-rate them again. We saw a pretty good sell down in REITs. I want to say, what was it? Like, around here. Yeah, I think that's kind of what broke ARE past that 110 mark and down in the 90s. So my valuation still stays the same with ARE. Nothing's changing. I still think, high 80s, mid 80s is a really attractive point with a lot more risk baked in. To get there, I mean, shoot, we'd be talking like going back to 2016 numbers. We're already actually in 2016 area. Last time price was here was around June, July 2016. So it's sold off a lot. We're nearing 7-year lows, 8-year lows. And the 10-year low is at about $60 or so. So it'll be interesting to see what the market does with this. Sentiment can get really bad, and we can see crazy areas of potential opportunity. Sometimes those opportunities turn out to be really bad, and maybe it is going to zero. But in this area, it's pretty dang attractive. Another one that I've been looking at for REITs is CCI, and the CCI is going to have some headwinds over the next I think it's 16 months or so with the wind off of the Sprint assets, basically consolidation of the Sprint assets, and the T-Mobile assets from that merger. So they're going to remain pretty weak. I want to say did I start this one about $98, something like that? Yeah. I think I started position around 98, very small position, and I'm really looking for kind of that $80 range. $80 would be pretty ideal from the evaluation that I did. And at that point, I think a lot of risk is baked in. Yeah, it's going to be interesting because if rates stay higher for longer, the market's got to bake in that additional headwind, the additional risk. Because instead of maybe the market saying that these guys can refinance their debts into lower rates in 2 years, if they can't refinance that debt into lower rates in 2 years, and it's going to end up being like 5 or 6, then we're going to have additional increase in interest payments. Their cash flows are going to go down. So that's just going to be a pretty big headwind for them. On top of the headwinds that they're just having overall in the industry with that asset wind down between Sprint and T-Mobile. So pretty interesting. The higher quality player to CCI would be AMT. And AMT is, again, in a really nice sell down, right? So if we look year to date, it's kind of interesting. Let's go here. If we look year to date and we compare this to something like KRC, so let's do KRC. You can kind of see that KRC ended up, or a lot of office in general ended up putting in at least a temporary bottom a bit earlier than a lot of these higher price triple net REITs. So it seems like office might be on the bounce back. Look at ARE, look at I can't remember it. It's Boston Properties. I can't remember the symbol though. Let's see. We'll go by Boston Properties. Nope. Is it BXP? BXP? Maybe. It might be BXP. I don't know. Or we're just looking at something weird. And we can look at like something really a lot higher risk like BDN. And yeah, all of these kind of put in that bottom right around 516 and have bounced back. And while the other players have kind of remained a little bit weak. So if we go to let's do CCI and ARE, there we go. And then we can actually pick out the exact dates. March, May 16th. Here we go. We can kind of see the bounce back in office and the continued sell down of some of the triple nets or life sciences that were pretty much priced, I would say, more for perfection. So office gave us a pretty good opportunity. Well, at least it looks in hindsight like it was a good opportunity. We'll see if we make new lows on the office REITs, but they were getting really, really cheap. Pretty much from a lot of scare from the work from home being the new thing and just a wind down in office. But interestingly, a lot of these office REITs right here have been getting into life science. So yeah, just at the time, I just thought the valuation wise, these were much more attractive than ARE, but ARE is getting into that point where it's starting to get, I would say, very attractive, and it's going to be a little bit more stable as far as the leasing compared to some of these office REITs. So yeah, got opportunity in office earlier this year, and it looks like we might be getting opportunity in triple net and maybe industrials, just basically REITs that were more priced for perfection, or they're lower risk. Now I think what's happening is that since the market is looking at essentially having the risk-free rate be higher for longer, I think that's going to put a really big drag on some of these REITs that are still priced fairly richly when compared to the risk-free rate, right? Like personally for me right now, I'm not really in a rush to buy much of anything because if I can get 5% in a savings account, like shoot, that's pretty dang good. Another one that sold off heavily is ADC, and you can kind of see, just compare that to let's do KRC. And yeah, pretty big deviation, like a 32% deviation over the last 6 months or so, or 5 months. Year to date, let's see what that is. Basically about break even. Well, no, it's still KRC has about 5% on it. And if we look at just compared to SPY, real estate has been one of the sectors that has sold off pretty heavily compared to just the overall market, and tech has been carrying us. Speaking of tech, there are certain companies that I would not mind having additional exposure to, even though they are the top 3-4% or 3-4 holdings in my individual stock portfolio. So Amazon got it built out pretty big, not pretty big, a nice size. So Amazon and Google got built out to a decent size in the mid 90s area, like 95 to 98 on both of them. Just price happened to line up. So those are two, though, that I would not mind adding to in a larger pullback. So we'll see. I don't know if it's going to get back down into these previous low areas, but if we did get a nice pullback, we're already in a nice pullback, but if that can continue and these remain pretty weak, those will be ones that I am willing to jump on and increase that allocation a little bit. So I use Financial Modeling Prep for all of the API queries for my spreadsheets, and I do have a referral to Financial Modeling Prep in the description below. It takes about 20% off of the normal pricing. Additionally, if you want access to this valuation template, you can join the Stone Cold Investors Discord, and that link will be in the description below, and the valuation template is available to all supporters of the Discord. You can become a supporter of the Discord by writing 3 different valuation or company write-ups in the Stone Cold Investors Discord, or if you don't want to do any of that and you just want to lurk around, you can sign up for a $5 a month supporter tier, which will give you access to the channel that has the valuation template. As always, I am not a financial advisor, and none of this is financial advice. This is just my musings on another company and another potential valuation. So I hope you enjoyed it. If you did, please hit the like and subscribe button, and we'll see you in the next one. I think that's about all I got for you guys today. Just wanted to put a video out there, and it's been a while, so had to get something out there. So hope you guys have had a good couple weeks or whatever, and we'll catch you in the next one.